A lot of investors get stuck on the question, should I buy a simple buy-to-let or go bigger with a HMO? And I know the feeling, and I've actually invested in both. And trust me, they both come with pros and cons. So in today's video, I'm going to break down how buy-to-lets and HMOs compare. Breaking down how the cash flow stacks up, how the capital appreciation stacks up, and what it means for your long-term wealth and lifestyle. And most importantly, I'll give you my opinion about which one I think is the right one for you. Because ultimately, the right decision depends where you are in your journey and what your long-term goals are. So let's get into it. Hi guys, my name's Jim, and I'm based in the northwest of England. Currently invest in buy-to-lets and HMOs, and I've actually set myself a target of owning 50 HMOs. And on this channel, I'm bringing you along for the journey, sharing everything I've learned and everything my network knows as well. So if you're interested in building cash flow and understanding how property really works, then you're in the right place. And I upload new videos every single week, so make sure you subscribe and don't miss them. And let's get into main point one, which is returns, cash flow, and financing. So let's compare the rental income from a standard buy-to-let and a HMO. So in our standard buy-to-let, this property would rent out to one tenant, and it might get us £750. And if this property is a HMO and it's got 6 tenants, and each room rents out for £500 a month, the rental income would be £3,000 per calendar month, which obviously has an impact on your profits, because with a buy-to-let you'd have your mortgage, maybe some insurances, and best case, let's say your profit was £200 per calendar month. And for the HMO, you'd have similar costs. You probably have more because you have your council tax, Wi-Fi, cleaners, probably a higher letting agency fee as well. But let's just say, to keep the numbers simple, you're going to make £1,000 per calendar month. So straight off the bat, when it comes to rental income and generally profits, HMOs are going to make you more money every single month. But it is worth mentioning, and it's something I'll touch on later in the video, for this £1,000 a month, there are more moving parts. You got more bills to manage and more tenants as well. But this leads us on to the sub points about rental cash flow, and this is a risk mitigation strategy. So with our buy-to-let, if this guy doesn't pay his rent for some reason, I don't know, maybe he's fell on hard times, he's lost his job. If he can't pay and we lose this, 100% of our income is gone. Whereas for this, if one of our guys couldn't pay their rent, we've only lost 1/6 of our income. So in the HMO, sadly, if one person lost their job, we'd only lose 1/6 of our rental income. And really, it's the last 2 rooms in a HMO which make you your profit, so you should still break even with 5 out of your 6 rooms full. So ultimately with a HMO, you're spreading the risk across multiple tenants, whereas with a buy-to-let, it's centralized. Now the final point on this first section is around financing. Typically in property, people use a lot of what they call other people's money, alternatively known as angel finance. So you might have 2 parties, and party A agrees to lend party B £200,000 over the course of 2 years for a fixed return. That's the general principle. And lots of property investors utilize this strategy. Now, when it comes to attracting these investors for a buy-to-let or a HMO deal, generally HMOs are more attractive. And this is largely driven by the fact that they make more money every single month, so the return's higher. So from an angel point of view, this deal is more lucrative. Now the angel might actually end up wanting to joint venture with you, which is where they become a partner in the deal. And if they were to do this on a HMO deal, they generally make more money every single month when compared with a buy-to-let. Buy-to-lets are just a harder sell for private investors. Don't get me wrong, you can still 100% use other people's money to purchase buy-to-let properties. You just need to be making sure the deals are really good. Because generally, if you're to go on Rightmove and try and find a buy-to-let deal, to use someone else's money to purchase it, you're probably going to struggle because the deal's not going to be good enough to be able to pay them back as well. We actually used angel finance to complete our first full back-to-brick HMO conversion. So if this is something you'd be interested in, maybe enjoying some of the returns you can get from HMO projects, we've actually got an investor waitlist in the description below. So fill it in and then we can have a conversation about how we could potentially end up working together. So when it comes to cash flow and monthly returns, I think it's a bit of a no-brainer. HMOs definitely take the W, because you're talking about a deal which can potentially generate you £1,000 a month versus a deal that at best case at the moment can make you £200 a month. So for me, from a cash flow side of things, it's an absolute no-brainer. And then you add in the fact it's generally more attractive to angel partners as well. HMOs take the win on the first section. Now the second point is super important for property investors, and it's around capital growth and the value of the property. Now on this first point, we're going to talk about 2 general strategies. One where we force the capital appreciation up, and one where it goes up generally over time. So let's talk through a buy-to-let example. So generally when it comes to buy-to-lets, they're valued on a bricks and mortar valuation. A bricks and mortar valuation is simply how much that property is worth based on the bricks and the mortar in it. Sounds really simple, but that is it. It's just how much that property is worth on that current street, in that location, in that condition. Whereas generally, most HMOs 6-bed plus are valued on a commercial basis. And this is like generally how businesses are valued as well. So when we talk about commercial valuations, it's based on how the asset performs as a business, not necessarily the bricks and mortar of the actual property. So generally, commercial valuations will take the rent over the course of a year, and this will be factored in with a yield multiplier. And this is where we'll get a commercial valuation. Now generally, buy-to-lets are valued on a bricks and mortar valuation. Now the general wisdom is that the property market will double every 15 to 20 years. And this is a massive advantage for properties which are valued on a bricks and mortar basis. So any buy-to-let portfolio. So if you take a standard 3-bed terrace property and say it's valued at £200,000 today, and we had a portfolio of 5 of these, that means our portfolio would be worth £1 million. And a 75% loan to value, that means the debt we'd have on this portfolio would be £750,000 with £250,000 in equity. That's how much we'd actually own in the portfolio. And let's say 20 years down the line, property prices have doubled. So that means each individual property is now worth £400,000. So our portfolio of 5 properties is now worth £2 million. But because we've got interest-only mortgages, our debt would still be £750,000, and we just service that debt every single month through rental income. So that means our equity would now be £1.25 million. And this is really the magic of buy-to-let investing. Over the long term, you can hold an asset and wait, and then you can build up lots of equity in it. Now, if we were to compare this with a HMO, things are a little bit different. This is largely to do with the commercial valuation element. So when we take a normal standard property and maybe convert it from a 3-bed to a 6-bed, we're forcing up the valuation by adding a commercial element to it, and the bank will lend against this. So if we maybe add studios or en-suites into the property and we can get a higher rent, the bank will lend against this asset on a commercial basis. The challenge with this is in 20 years time, this property isn't going to be worth double because it's based on the rental income, not on the bricks and mortar valuation. So let's say we had a 6-bed HMO and it was making £3,600 a month, which is £43,000 a year. And it was a pretty good area and it had an 8% yield. That means the commercial valuation would be £540,000. What we've done there is front loaded the uplift by adding a commercial element to it. But in 20 years time, there's no way that HMO would be worth over £1 million. What does this mean from a capital appreciation point of view then? Well, HMOs are generally a bit better in the short term because we can force up the value by adding this commercial element to it and getting commercial lending against it. But over the long term, it's not going to skyrocket like a buy-to-let is. So if you're solely after capital appreciation, it's got to be buy-to-let on this one. Now this leads me on to my next point, which is around Article 4. And this does add extra value to HMOs. Article 4 is simply a directive by local councils to manage the amount of HMOs in certain areas. And I've actually done a full breakdown video on Article 4, which I'll link at the end of this video. So make sure you check that out. But basically, it gives local councils to have more control about the number of HMOs they can have in certain areas. Which naturally, if you restrict the supply, it means anything that is there in that area becomes more valuable. And sometimes this can be 20 to 30%. Whereas this isn't the case with buy-to-lets. There's no mechanism at the moment for local councils to control how many buy-to-lets are in an area. It's generally left open to the free market. Now don't get me wrong, we generally don't have enough places for people to live anyway, so that does put a premium on buy-to-lets, but not in the same way as it does with HMOs in Article 4. So buy-to-lets generally don't benefit from this scarcity in the same way HMOs in prime city centre locations do. Now we've spoken about capital growth and we've spoken about scarcity, but let's talk about value and money left in deals, because this is a big one for most investors and it's ultimately the blocker for how most people do or don't scale. So we're going to talk through 3 different examples, 1 buy-to-let and 2 HMOs, to talk through how money left in deals can look different ways. Now let's say we purchased a buy-to-let at 200k and then we did a small refurb, maybe put a new kitchen in and a new bathroom and stuff like that. And the GDV, which just stands for gross development value, which is the back end value once you've done the refurb, is now 220. So we've added £20,000 in value, which means after the refinance, the money left in, so this is the difference between what we can refinance out and what we spent, is 40k. So we've left £40,000 in that deal. So that £40,000 capital is tied up in that buy-to-let. What we need to understand is how hard is this £40,000 working for us and what return is it getting us. So let's say our monthly profit is £200 per calendar month. That means over the year, it's £2,400. And we've got £40,000 left in the deal. So our ROCE, which I spoke about on this channel before, the return this £40,000 is getting from this annual profit, which in this case, will be 6%. Now this is relatively generally pretty typical for a buy-to-let property. Don't get me wrong, you might be able to leave less money in and you might make a shed more. But maximum, people who are doing well might be getting as high as 15%, and that is really good on a buy-to-let at the moment. So one of the main advantages when doing HMO deals when it comes to money left in is generally you can leave less money in because you're forcing up the value with the commercial element to it if you're doing 6-bed plus. So what does that look like? So let's say you've purchased a property again for 200. Your refurb and fees are 80. I'm just doing these relatively simple to give you an idea. So yeah, that means total you're at 280k. And then your GDV, as we discussed before, your back end valuation, so this will have a commercial element to it, so this would be higher, would be £500,000. Then when you refinance that at 75% loan to value, you pull out 375k. So in this instance, money pulled out would actually be 95k. Now this is just an example. It's a pretty extreme one to prove the point. I doubt many people are pulling 95k out of HMO deals because you definitely have to spend more on your refurb and other fees, but this is generally the point I'm trying to prove. The potential is there because the GDV is higher. Now that means as an investor, your job is to make sure you can manage the purchase price and the refurb and any other associated fees, manage that as low as possible so you can eventually try and aspire to end up pulling money out of a deal. Now this would be, never mind a unicorn deal, this would be like leprechaun, insert, other magical, mythical creature that doesn't exist type of deal. But generally people are gonna have to leave money in deals. It's just the nature of the market at the moment. Unless you can buy at super competitive prices and you can do refurbs at build cost, you're probably gonna have to leave some money in deals. So what does that mean from a HMO point of view? Because we've already looked at return on capital employed from this buy to let was 6%. So you'd imagine with a HMO it'd be higher. So let's run through an example. So let's say we had the same deal and we purchased it and did the refurb for 280k. So let's say our GDV was 350k. That means at 75% loan to value, we'd pull out £262,500, which means our money left in the deal would be £17,500. Now generally a profit on a HMO, you should be looking at around about £1,000 a month. So our annual profit will be 12,000. So now we need to work out the return that the capital employed, which is our 17.5, is getting. Our return on the capital which is employed, in this instance, will be 68%. I was gonna take a brain session to work out that 68 is higher than 6%. And this is one of the key advantages about HMOs. If you do leave money in the deals, the return you get on that money left in the deal is a lot higher. I mean, generally in the S&P 500, you're looking to average your return of around 10% a year. Whereas in this instance, your money left in this deal will be getting you 68% a year. Not forgetting, after 17.5 months, because you're making around £1,000 a month, you'd have all of that money back. So the return on the HMO would actually be infinite, which is the major power of property investing. And in this instance, it's a massive advantage of HMO investing. You've generally got more opportunity to pull more of your money out, but if you do leave money in, you get high return on that cash. Now, so far, this video has been focused a lot on capital appreciation and cash flow and the sort of money elements to it. But now I need to talk about you as an investor and what your goals are, which leads me on to the point of passive versus active investing. Now, from my experience, investing in buy-to-let is the most passive way to invest into property. It's got the least moving parts, there's the least overheads, and there's the least headaches involved. So if you're definitely trying to optimize for a passive point of view, buy-to-let is the way to go. HMOs is completely different. It's one of the most active ways to invest into property, and particularly with all the changes around legislation and compliance and stuff like that, it is becoming a full-on business. So if you think you can probably invest in HMOs from a passive point of view, my experience has told me different. I think that's definitely a lot more of an active income. Don't get me wrong, there are passive elements to it and you can outsource different stuff, but fundamentally you're still going to have to be involved in certain elements of running a HMO portfolio. So if you want simple and generally passive, buy-to-let's the way to go. But the trade-off, like we spoke about, is you get lower returns. Whereas HMO, the returns are better, but it's definitely a lot more, it's a more active property investing business. Which also leads me on to the next point about how quickly you want to scale. If you're super ambitious and you want to scale up really, really quickly, then you probably want to look at a strategy like HMOs, because generally you can recycle your money out of these deals a lot quicker than you can with a buy-to-let. That's to do with commercial valuations and also your monthly return. Whereas if you want slow, stable, maybe build up a pension pot for when you retire, then buy-to-let is probably more centered towards you. The challenge with buy-to-let is you're probably going to need more of your own capital to do that over the long term, which if you can take the super long view, isn't necessarily a problem. It's just where you're at as an investor. Do you want the slow and steady approach, or do you want to grow super quickly and be active in that business? So again, this sort of suits with the theme. If you want slow and stable, buy-to-let's the way to go. If you want to go quickly and you want to build up your cash flow really quickly, then HMOs is the way to go. Now this all links into what type of investor you are. Generally, from what I've seen, and this is definitely the stage I'm at, Early stage investors are looking to scale and grow quickly. They want to build cash flow and they want to recycle money out of deals to be able to grow again, to grow quickly, to build up this cash flow. So generally for these early stage investors, HMOs are the way to go. Whereas at the other end of their investing career, if you've put all the hard yards in and you just want simplicity and an easy life, generally from what I've seen and I generally recommend, these people invest in buy-to-lets. They just park their money into a buy-to-let knowing they're going to get a safe return for little admin. But here's the secret bit. The investors I see who are doing property investing the best are actually doing a mix of these things, which is definitely where I want to be. They're building the HMO for the cash flow, but then they're also taking the funds they make from the HMOs and parking them into buy-to-lets for that longer term security, which generally is going to give you a more balanced portfolio from an equity point of view. Because as I spoke about in my pros and cons of HMO investing video, there is a risk to become over leveraged with commercial valuations. So if you can offset this by investing heavily into buy-to-lets as well, that's where you can get a balanced portfolio. So ultimately it depends where you're at your property investing journey and what your goals are. If you've got ambitious cash flow goals and you want to scale quickly, you're probably going to go to HMO. If you're someone who's already got funds, maybe from a business or a job, and you want another stream of income for your pension, then buy-to-let is probably the way to go. Because investing in HMO takes up a lot of time and bandwidth, whereas buy-to-lets, you can generally do that on the side. But for me at the moment, my focus is definitely on HMOs because I want to turbocharge my cash flow. But like I've mentioned throughout this video, it depends on what situation you're in and where you're at. So I hope you guys enjoyed this video. And if you're still confused about what you should do, drop a comment below and I'll try and help out. Don't forget to fill the investor waitlist in down there as well. And I'll also link the Article 4 video on screen now. See you in the next one.